Recording. All right, that's my backup. And all right, I'm gonna start my main recording now. All right, hi everyone. Welcome to day 3 of this event, Synergy Traders number 56, our 7th annual Women Teach Trading and Investing for 2025. This is live on TimingResearch.com, and of course, this is brought to you by my partner Anka of TradeOutLoud.com and myself, David of TimingResearch.com. Also with our co-sponsors, OptionProfessor.com and MadHedgeFundTrader.com. So just a reminder, all of these presentations are for educational purposes only. And um, trading is not suitable for all people. And only trade with money you can afford to lose. And please consult a financial advisor before you risk any money in the markets. So all of these sessions are being recorded individually, and they will be available on TimingResearch.com as well as the Timing Research YouTube channel and podcast apps. So first up today to open the day for us is Anne Logue of AnneLogue.com. So I'm going to go ahead and turn it over to her.
Hey, thank you, David. And it's fun to be here to start the day on a day when the market is not so much volatile, it's just straight down. So it's a kind of a fun day to be short if you're short. I am the author of several books about investing and trading, including Day Trading for Dummies. I write a lot about business and finance for a lot of different publications and um, probably almost every financial services company out there, I think, some days. And then I have a Substack called The Whatever Years, which is about finance and money, but it's also about a lot of other things. It's sort of Generation X trying to get through the world. So, if you're interested, it's a lot of fun. At least it's a lot of fun to write. But here today, we're going to talk about money management. And for some of you, this may be review, and that's fine. But this is the really principal stuff, the basic stuff that determines success and failure in the long run. I mean, the last couple of years when the market was strong and everybody decided that they had just discovered NVIDIA for the first time and they were trading geniuses. And now we're in a market situation where things are a lot more volatile. And so for newer traders, this may be new information, but it's critical. And for more experienced traders, it's just a reminder that if you've been getting a little loose with your trading habits, it's time to revisit them. So it's really the key to trading success, much more than picking, finding great things and running with them. And that's important too. But in the long run, you've got to manage your money and your risk. So we're going to talk today about why it matters so much. We're going to talk a little bit about building trading plans, choosing position sizing, stop loss orders in particular for people who are trading long. It's, crucial right now. But actually, given the volatility, if you're short, who knows? Tomorrow could be up a big day. And so if you don't have your stops in place, you're screwed, right? Just some advice, some tools to help you stay consistent on this. So we're going to start with a trading plan. Start with a plan. Okay. And the reason you want to do this is a trading plan will help keep your losses smaller and manageable. You're going to lose money when you're trading, and that's fine. But if you can cap your losses and let your winning trades run, you're going to make money in the long run. And I'll show you the math of that. The other reason you really want to have a trading plan is that it will help you take the emotion out of your trading. And in days that are volatile, the emotion can really get in your way. Again, a year ago today, it would just be like, yay, I picked NVIDIA. I'm a genius. I don't even need to trade anymore. I'm just going to run with NVIDIA. And NVIDIA is still doing well. But you need to it's the emotion that will undo you, right? You always hear the doubt, the fear, the greed. Some people prefer fear, uncertainty, greed, but that's will really that will really cause you problems. And the thing is, most traders in the market are electronic traders. There's a lot of algorithmic trading on the part of the big brokers and the money managers. And so you're trading against machines. So you're the emotional trader, not them. And keeping that in mind can really, really help you a lot because you can't get angry at something that has no soul, no meaning, it's just happening without you. And if your meaning is somehow tied to your ability to uh, you know, be better than another person, it's a lot different when you're against a machine that just is a machine, right? And then finally, having a trading plan really builds the long-term consistency. And that's the thing. Again, a lot of people maybe got away from things, but it's time to think about being consistent. And that's what makes you money. So your trading plan is fairly simple. It's what are you going to trade today? And you can do it longer term. You can think about it in a couple of ways. You can think about it longer term if your trading is a business, right? Businesses have business plans. They come up with new strategic plans at least once a year. What are they going to do? What markets are they going to trade? Are you going to trade? What assets are you going to concentrate on? Because if you have some specific things that you're looking at, you'll get to learn them better, right? What happens. What happens in the market if you're trading overnight is going to look very different than what happens if you're trading during the trading day. And a lot of people prefer overnight trading because it matches when they have free time. Because if you have a 9 to 5 job, you can't really be trading on the side. If you have a 9 to 5 job, you can't really day trade on the side, okay? You can do other kinds of trading, you can do swing trading, you can invest, but yeah, you can't, your boss isn't going to let you, do that. But okay. So what you're going to trade, what is your edge? What is your strategy? Okay. Your edge could just be that you're better at managing your losses and work and improving on that because that can really improve your profitability. But what is it that you seem to be good at? And knowing that up front, and being able to specify that, that comes with experience, that comes with tracking your trades, which we're going to talk about a little bit too. What is your maximum position size? I'm going to go into money management, but you really want to know what it is and you want to stick to that, right? The market isn't, just because you think you have a sure thing, if you have a sure thing and you enter that trade wrong, you no longer have a sure thing. And that happens to people all the time, happens to the best of us. When you will enter and exit, how you will enter and exit. And then again, tracking your performance. That is just critical because you need to do that to feed into a trade. Again, this is a lot like a business. It's your own little business, but think about it that way and you'll be better able to take on the exotic machinery that is the financial markets, right? So, in terms of evaluating performance, and we'll just kind of things you're looking at because it's, what are you tracking? What are you trading? They always say you manage what you measure. Um, Keep a detailed trading journal. There's a lot of great, you can do your own spreadsheet. There are a lot of people who've created spreadsheets and trading journal services. I know some traders who still keep things in an old notebook, and that's fine, but you want to write down what was your entry, what was your exit, what was your stop level? Did the trade work out? How do you feel about it? Do you understand why it worked out? Did you follow the plan? Did the plan move against you? Were you following the plan and then there was a news announcement that, screwed everything up? you wouldn't necessarily know going into it what the news announcement would be. You can't adjust for that. That's why there's risk. And you want to regularly review your trading plan in conjunction with your trading results. So, if you are finding that maybe your stops are too tight for a volatile market, and I'm going to talk about that, but I think that's something a lot of people are kind of facing right now. When you have extreme volatility, the kind of stop levels that worked in a more stable market don't work as well now. Okay, so um, money management, money management. It's all money management, right? So as you have your trading journal, you can start tracking things like what percentage of your trade are winners. Okay, you only need just more than 50% of your trades to be winners for you to make money in the long run, right? There's a lot about trading that's a zero-sum game. For every winner out there, there's a loser, and there is a big element of randomness in the market. But if you can get even a slight edge in the long run, you can make money. When you have a winner, what's your average gain? Right? Are your limits too tight or are your limits loose enough? And we'll think about that, right? When you have a gain, is it running? Is it making a lot of money for you? What percentage of your trades are losers, which is kind of the opposite, 100 minus the percentage of your trades are winners. But you want to know that. And it might be high. I mean, don't be upset if it's 49%. If it's 49%, you are ahead of the game, right? In the long run, you are ahead of the game. And then what's your average loss? If you can control the losses on your losers and you can let your winners run, you can come out ahead. You can absolutely come out ahead. And so based on that, what do you have as your expected return? If you're just getting started in trading, you're not going to have this data. But if you start tracking your trades, you have a journal, you track your trades, you'll eventually start to get it. And then you can review your trading and adjust it based on this. If you have your trading journal, but you haven't reviewed this information in a while, this is a good time. First of all, you've got this great 3 day workshop where everybody's thinking about trading. So you're thinking about what are things you can do to what are some things that you can do to improve your trading? You're going to leave here with all kinds of great ideas. So you've got a weekend. You've got a weekend to go through your trading journal, your trading plan, and it's a good time to reassess this, thinking about, okay, what did I do this last time period? How can I improve my trading going forward just by managing my winners and losers? Okay. Now, the expected return calculation is simply what's your percentage of losing trades? What is the percentage loss on losing trades? What is your percentage winning trades? What is your percentage gain on winning trades? So, if you can, even if your percentage of winning and losing is 50-50, right? If you look at this equation, I think the next time I do this, I'm going to do a slide actually, like taking the math even further. But let's think about this, right? If the expected return, if it's 50% losing trades, 50% winning trades, then you get to the next factor. What is the loss on losing trades? What is the gain on winning trades? If you can limit the loss on the losing trades so that your gain on the winning trades is larger, you are going to make money. Okay. Okay. If that math doesn't make sense, you can leave a note in the chat or ask questions later. But really think about that, right? Like if you're just sort of like, think back to 8th grade when the teacher put all this on the blackboard and you're trying to understand your basic algebra. That's really it. It's, if you can get this if the first variable, right, if percentage of losing trades and winning trades is the same, again, 50-50, then reducing your loss on losing trades, increasing your gain on winning trades, you will make money. You might not make a ton of money, but you will make money. Also, if you can, manage any of these variables so that you lose slightly less, win slightly more, if you, in terms of numbers of trades, if you can reduce your loss on losing trades, increase your gain on winning trades. And this is where money management and setting stops really comes into play. Okay. So just think about this equation. I know it's a lot of math for first thing in the morning, but math is more fun than looking at the market today. But that's the number you want to get. That's the number you want to get up. Now, this is what they call the probability of ruin. And this is another thing to kind of think about. Okay. Because this determines how quickly your account goes to zero. And this is getting into not only like managing the percentage of winning and losing trades, but also gets into the importance of money management. Okay. So again, if the percentage of winning and losing trades is the same, your probability of ruin will be slightly higher than if the percentage of winning and losing trades is different. Okay, so let's say we start with just 50-50, right? One minus half, 50% is going to be 50% on top. One plus 50% is 1.5. That's a third times whatever the number of trades, right? If you're placing one trade, if you're betting your entire account on a particular trade, it's going to run out of money faster. And so if you're starting with a small account, really want to make this clear. If a lot of people who start trading, they don't have a big trading account. Look for assets where you can trade smaller accounts, not penny stocks, not meme coins, because those also have other risks with them. But, thinking about like mini contracts, micro mini contracts, thinking about, working with brokers that will let you trade fractional shares of stock. And there's plenty out there, but really think about that, get started. The magic of compound interest, the magic of compound returns is that small returns add up over time. So if you're starting with the small account, if you have $1,000 account, a $500 account, you're not shut out of the game, but you want to manage this carefully. You don't want to be a gambler, you want to be a trader. Traders manage their money. They start small and they let compound interest work for them. So let me show you. If you have no edge, ruin is inevitable. Okay, if you're talking about 50-50 trading, you have an advantage. That advantage is getting a higher return on the trades that work than on the trades that don't work. Okay. But improper sizing becomes critical, becomes the thing you want to take on, right? Again, you think you have a sure thing, and you think if I have major systems hacks, you think about, tariff uncertainty, things that just kind of come out of nowhere that can blow up your sure thing. And also, if you make a mistake in your order, everybody else is automating. But that's not really the topic of this presentation, right? So go with somebody, somebody else will be talking about that today, I'm sure. Um, so your trading is zero sum, right? You have a 1% trading advantage, and that's pretty high. So then you sit there and you think, okay, are there things I can do to improve my advantage? Or are there things I can do to place more trades at any one time? And that, you know, to place a larger percentage, or excuse me, smaller percentage of your portfolio, that'll keep you in the game. This chart, which I think is just beautiful, which breaks out the whole probability of ruin based on your advantage and the number of trades you can place at any time with your portfolio. And so you can see how having the larger portfolio or having the ability to place more trades, if you go down to the 10 column, if you can get all the way up to a 20% advantage and 10 trades, your hedge fund or some, high-end trader who just completely blew up. It happens to the best of them. So there's no shame in it. But again, knowing this up front can help you manage it before you make a mistake. All right. A lot of position sizing systems. GAN, when we talk about, I mentioned the 10% number. GAN is super easy, 10% per trade. Fixed fractional, you set a set percentage of your total account per trade. There's the Kelly criterion, martingale. I'll kind of walk through these now. But these are also critical, right? You don't want to lose all your money on one trade. GAN is super easy and it's also really effective. And a lot of traders use it. And it's simply your money is 10 equal parts. And you never place more or less than 10% of your money on one trade. 10% goes on the trade. If it works, your next 10% value will be slightly larger, right? Because you're getting some, you'll see like the size of your trade go. If you have a $1,000 account, go from $100 to $101. But you'd be very consistent about that 10%, that 10%. And because it's effective, why not start with that? Why not start with that if you don't have a money management system in place now? Just do that. And it'll make your life easy. If you want to get to something more sophisticated, the more sophisticated ones, you need to have more data on what you can do. Excuse me. As you collect more data on your trading, you can start looking at more sophisticated types of money management. But again, a lot of these call for data. So the fixed fractional is you start with the number of shares or contracts you want to trade. You start with the fraction of your account that you want to trade. And then equity is the value of the account, and the trade risk is the amount you can lose. And so you play around with this number to solve for F, right? So it's algebra. Now, the beautiful thing is that almost all brokers have money management sizing systems in their toolboxes. So you want to find that and you can experiment a little bit, again, as you get more data on what you're doing. The Kelly criterion is a really fun one. It is also a little bit harder because you need to have more math. This was developed by some mathematicians at MIT who actually went in and traded roulette and changed the rules for it because they made so much money. Um, I always hear this rumor that if you're, a graduate of, a professor at MIT, you're not allowed to trade in Vegas. I don't know if that's true because I don't know any professors at MIT, but they said, okay, first you figure out the percentage of your trades that win. Again, that's why you gotta like do your math. And then you want to figure out, you know, what is your average gain and your average loss. And then you use this equation and it will give you the percentage of your account that you should trade. It's a really effective system, but you do have to have the data to make it work, right? You have to have the data to figure out, what's your percentage of trades that win, what's your average percentage gain, your average percentage loss. Um, Again, GAN's easy. Start with GAN, collect your data, maybe then try Kelly criterion. But you need to have data. And, what I learned when I took statistics back in the dark ages is that you need at least 32 samples to start approaching a true statistically significant distribution. So, if you start trading, you may be in a couple of days, in a month, be able to start calculating a more sophisticated money management system. But if GAN works for you, stick with it. Don't change just for the sake of changing. But if I were to change from GAN, this would be what I would do. Okay. Martingale is an ancient casino system. When you hear people talk about, doubling their trade, doubling their money, it works, but it works if you have an infinite amount of money to trade. So you start with the set dollar amount. You're like, okay, I'm going to trade $1,000 per trade. Your first trade wins, you just keep trading $1,000. If your trade loses, you put $2,000 on the next trade. If that trade loses, you put 4,000 on the next trade. And you just keep going because the idea is that you will earn back your losses if you place double the amount. But the challenge is you need to have that infinite amount of money to trade. And so you might be tempted to try it because it does work. And again, a lot of gamblers do this, but we're not gamblers here. We're traders. We respect risk. Traders respect risk and work to manage it. And so you can do this, but I would not recommend it. Um, and you know what? If you go to Vegas, you get drinks when you lose money. You get tickets to shows when you lose money. If you're a trader and you lose money, you don't get anything. So, keep this to the casino where your losses are at least compensated for by drinks and show tickets and things like that. Now, the Monte Carlo simulation is another one that's very sophisticated. And if you have data on your risk and return, it's another one like Kelly. It's very sophisticated. And it's only really been recently that average people have had access to the computing power to calculate this. And I don't want to make light of that. This is the kind of advantage that major brokerage firms, major institutional traders have had access to, but individuals haven't. But in about the last 10 or 15 years, computing power's gotten cheaper and programming's gotten better. And my guess is your broker's toolkit gives you access to um, your broker's toolkit gives you access to Monte Carlo simulation. And I think you should consider it. I think you should consider it. And I have a question here on the issue of the difference between gamblers and investors. And it seems that good gamblers would make good investors. I would say no. Although I know some gamblers, some investors who like to gamble. Um, I think they're just different things. It's kind of like there are investors who like to play golf, you know? And the big difference, there's a couple difference. One is that some gamblers, if you get into all the psychology, um, some gamblers are sort of driven by a death wish, you know. Especially if they develop a gambling problem, they're often driven by some kind of desire to lose, to show that, you know, a death wish. Let's put it, say death wish. That's simpler. Um, some people who say they are traders are actually looking for legitimate ways to gamble, like socially acceptable ways to gamble. And I think that's an important thing to know because if you've got a problem, if you're dealing with deep psychological traumas of some sort, and you're day trading as a way to gamble, then you're more likely to lose. Um, some, the other difference is that when you gamble, the odds are against you. And when you're trading, the odds are neutral. And that's, again, if you're dealing with neutral odds and your edge is managing your risk, you can make money, right? And if the whole joke about Vegas wasn't built by winners, and it's true, and that's why if you're losing money, they give you things like free drinks to encourage you to stay at the table, which, by the way, also reduces your ability to think clearly. But it's the odds are against you. And it's one of the things that's been fascinating to me to see is how, with the rise of all of these sports betting apps, is how often when people make a good trade, make a good bet, they're being told that there's some problem and it wasn't legit and they're being shut out of their winnings. So I think that's another interesting aspect of gambling versus investing. If you make a good trade, your broker doesn't care, right? Your broker makes money if you win or you lose. So, and I think that's a significant difference, really. I think that's the first time I've ever like said that out loud. But your broker makes money whether you win or you lose. Okay, when you're gambling, they only make money when you lose. So that alone makes a difference. Um, yeah. Okay. That's what I would think of. Okay. With Monte Carlo simulation, your trade size will vary with each trade, but that would be really interesting if your trading platform toolkit has Monte Carlo simulation, and they almost all do these days. See what it comes up with your optimal trade size and see how that varies. And really start thinking through, again, your risk and your return parameters and how that works. Um, so, okay. Now I want to talk about stops. Um, you're going to hear from some people later today who are going to talk about, um, looking at the charts for setting stops, and that's really important. And really think about this. I'm going to talk more generally about the importance of stops. Do not enter a trade without a stop. Do not enter a trade without a stop, right? Because again, you think everything, you're like, why? I'm going to let things ride, and then something weird happens in there. Um, Fixed stops, you just say a certain price level. I don't want to lose $5. I'm just going to base it on a dollar amount. Um, eh, or or you're setting it at, based on what you see in the chart. So you're like, okay, the resistance level is X, the support level is X. I'm going to set my stops based on what I see for support and resistance. Those are fixed stops, right? There is a fixed dollar amount. It's not necessarily the same dollar amount for every trade. Super reliable for managing your risk, and easy to use if if you're comfortable with charts. Setting it based on support and resistance is a great way to go. Trailing stops, I think if you're more of a swing trader or a longer term trader, trader slash investor, a trading stop is good because it adjusts to the current price. Um, and so you don't get into a situation where you have to wait for the market to just fall dramatically before you are stuck. Or actually, in the current markets, a trailing stop can give you a little bit of grace because things are so crazy. And that brings me to the volatility stop. Fixed stops are nice and basic. Trailing stops are good if you're a swing trader or if you are, crossing that line between investing and trader. But average true range in a volatile market like this, I think it's good, worth considering using that for your stop if you haven't. And again, think about this and think about your comfort with your stop levels and also what your current trading is, right? If you're currently successfully trading with fixed stops, please don't let me come in and mess you up, right? But if you're thinking about what your stop strategy should be, if you're thinking about how you want to change your trading, average true range is it's similar to a moving average for the stock price, but it allows for a greater range of stock price calculate of price calculation. And the big difference is that it includes the effect of gaps. And as overnight market, and a gap is the difference between the closing price one day and the opening price the next day. And as overnight trading becomes more important, and as we've seen this massive influx of news overnight, news at the top of the top of the morning, we're, gaps are becoming somewhat more common. And average true range considers that. And it really gives you a little more room to move in a volatile market on the upside, which is nice. And it gives your stop, it prevents you from being stopped out right away in a volatile trading day. So it also respects the fact that some stocks inherently, because of trading interest or because of news events, tend to be more volatile than others, right? So we're accepting that Nvidia's volatile, Tesla's more volatile, right? GM isn't, well, I guess it's becoming somewhat volatile. But the average true range calculation will come up in your broker's platform and think about, like if you're day trading, think about setting your loss at one average true range. And if you're thinking about something longer term, maybe setting it 3 ATR. And the other thing is because that adjusts, if things change and the market becomes less volatile, you're not stuck with this loss with a stop that's too broad, right? It'll kind of narrow up that stop size as the market settles down. And I know we're all hoping that I was going to say, I know we're all hoping that the market settles down, but a volatile market is great for a day trader. A volatile market is fantastic for a day trader. I have not used Ichimoku Cloud. There's a comment in the chat. Have I used Ichimoku Cloud? This person has had great success, and with different new indicators, I have not used it. So I know. Uh, that person's having a good stop to a Thursday. Obviously, a lot of people are having a good start on a day like today, because you could make money, what they say at the Chicago Board of Trade, right? Bulls make money, bears make money, pigs get slaughtered. It's true. And that's why you want to have your stop losses in place so you don't get slaughtered, right? Um, all right. Next up. Okay. Obviously, do not trade without a stop in place. If you're just getting started in trading, If ATR seems like too much for you, just start with a fixed stop. Like, okay, I'm only going to lose X amount of dollars based on whatever your loss parameters are. But if you haven't started trading, or if you don't have a stop system in place, I would say think about ATR, especially in a volatile market. Um, Support and resistance are fantastic if you know how to read charts. That takes a surprising amount of skill. But work on it because that will also improve your trading. And again, there's going to be people today who are going to talk more about that. So my summary here, number one, your money management is your key to success. Okay. That is going to give you a significant edge in the market. And then go back to tracking your trades, writing trade plans. Again, they don't have to be complicated. You can just have an old notebook if you don't want to do anything more sophisticated, and that's okay. But what you're going to trade, why you're going to trade it, what your stop is, what your loss is, and then after you trade, write down how it worked, what was successful, what wasn't, and do it right after you close the trade. Because even if you go back later in the day, your emotional state might be different, your memory might be different. Memory is so strangely malleable, right? If you sit down with your brothers and sisters, you all have different takes on the same event in the family. Um, so do it right when it happens. Periodically go back and review everything. Again, if you think about this as a business, you've got quarterly reviews, you've got annual reviews. Those are good times. If you haven't reviewed your trading in a long time, this weekend is a good place to start because we're in a volatile market. Volatility creates opportunities, but it also increases the amount of risk. Any trade can go to zero. Just keep that in mind. Just I've seen over the years, thanks to the Sarbanes-Oxley Act, it probably doesn't happen as much as it used to, but everything's great, and it turns out the company's a fraud and everything goes to zero. And it happens. It happens. Or it turns out that you're trading commodities and suddenly there's a a freeze in Florida and all the orange juice is ruined and it can go to zero. Entering the trade incorrectly can can just ruin a sure thing. There's one trader I've talked to who says that you should not trade until you do paper trading and do not start trading with real money until you can enter 20 trades correctly, right? So you set down how you're going to trade it, you enter that trade in your paper trading system, and if you've made a mistake, you go back to zero and you keep going until you get 20 correct trades in a row. That's not a bad idea because, again, you're against machines and you offer the opportunity for human error. And if you have the skill or you have the desire to learn, programming your trades, you know, is can really help a lot with this. There's a lot of between AI, language models, and between brokerage platforms, there's a lot of ways that you can program without being a programmer. And if you don't know where to begin, start with GAN, start with 10%, start with fixed stops, but really, really think about this. Think about what you're doing. So I've got a few more questions in the chat. No, 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 no. Just, yeah, log your trades, 20 correct in a row. Yes, thank you. I'm glad you think that's great advice for paper traders because I think it's good advice too. Um, so, and that's where I'm at. Does anyone else have questions on this? Or are you just ready for ready to take a look at what's happening at the market and then seeing how you can make money from it? if there's no more questions, I will end up here and then I guess David can come on and, oh, here we go. How do you start if you have a small account? Well, that's one. Um, One of the first things that I would say if you have a small account is to look for um, depending on how small your account is, you want to think about assets that are created for it. So, like the Chicago Mercantile Exchange has a lot. The CME has a lot of micro mini contracts for trading market futures, interest rate futures, commodity futures, and those are specifically designed for smaller traders. So that can be a way to get some leverage with a small account. Another is look for brokerage firms that have allow you to trade fractional shares or that allow you to place very small orders. Most allow small orders these days, like one share or five shares. Some allow for fractional trading, but that's a way to start. Don't just because you have a small account, you should still follow money management rules. And the other thing, of course, is that you can add to your account, add to your account every payday. Maybe it's only $50, maybe it's $25, but the money adds up. And so I would think about that, if it's really so small that you can't trade a single, that 10% of your account isn't a single share, you can keep paper trading to practice and start collecting the data so that when you have a larger account, you can commit more money, right? So start with your 20 correct trades, but then start paper trading, looking for market opportunities the same way you would, keeping track of what wins and loses. And then as your physical account gets larger, you can start putting some of the things that you learn into practice. Yeah. Any other questions? No? Well, then, if there's no more questions, I'm going to return this back to David. I know it's a few minutes early, uh, but you know,
Yeah, we have a few minutes. Is there, I mean, your great presentation, so
thank
thank you.
you.
But if, do you have anything else you can share with us about? Um,
Um, I think the reminder, that bulls make money and bears make money, but pigs get slaughtered. Or there's another version of that saying, which is that, pigs get fat and hogs get slaughtered. But that even if the market looks volatile, that's actually ideal for a day trader, because you can make money long and short. Volatility creates more opportunities for trades. Volatility creates more opportunities for a managed trade to run. And I think that that's fantastic. But just stick with the discipline. Stick with the discipline. Maybe you did make a lot of money in NVIDIA the last couple of years, and that's great, and I'm happy for you. But, get back to the steps that may get back to the basics, and you can continue to make money in a volatile market. Um, that is my summary of all of this. So,
all right, sounds good.
mhm. So thank you so much for the opportunity.
All right.